Here's something wild. While everyone's arguing about whether gold is outdated or the ultimate safety net, I've been quietly keeping 10% of my portfolio in it. And honestly, it's done exactly what I needed it to do. I'm Olivia, and welcome to the Money Compendium. Today, I'm pulling back the curtain on how I actually use gold. Not the hype, not the fear-mongering, just the real strategy behind why precious metals earn a spot in my wealth-building plan. Because here's the thing, gold isn't about getting rich quick. It's about something way more important than that. So let's start with what gold actually is in 2026. It's not some magical moneymaker. It's not going to double overnight. And honestly, most years it just kind of sits there. Sometimes it goes up a little, sometimes it goes down a little. And you know what? That's exactly why I keep 10% of my money in it. Think of gold like the steady friend in your group. Not the life of the party, not the drama queen, just reliable. When everything else is going crazy, gold shows up and does its job. Here's how I think about it. Imagine your investment portfolio is like a table. Stocks are one leg. They help you grow wealth. Bonds are another leg. They give you some steady income. Real estate might be a third leg. But what happens when the economy gets shaky and those legs start wobbling? That's where gold comes in. It's not trying to be the whole table. It's just there to keep things balanced when other parts start tipping over. In my portfolio, that looks like 10% in gold and precious metals. Not 50%, not 2%, 10%. And I'm going to show you exactly why that number makes sense for me. Let me break down the 3 real reasons gold earns its spot in my portfolio. No hype, just facts. Number 1, gold speaks every language. Unlike dollars or euros or any other currency, gold is gold everywhere. If you're holding gold, someone in Tokyo values it the same as someone in New York or Lagos or Sydney. It's been valuable for literally thousands of years. When paper money loses value, which happens more than we'd like to admit, gold tends to hold steady. It's like having a backup plan that the whole world agrees on. Number 2, gold zigs when stocks zag. Most of the time, when the stock market drops hard, people get nervous. They start looking for safe places to park their money. And guess where a lot of them go? Gold. This doesn't happen every single time, but it happens enough that gold acts like a cushion. When your stocks are down 20%, your gold might be up 10%. It doesn't erase the loss, but it definitely softens the blow. Think of it like wearing a seatbelt. Most days, you don't need it. But when you do need it, you're really glad it's there. Number 3, gold is nobody's promise. This one's huge. When you own a stock, you're counting on that company to do well. When you own a bond, you're counting on someone to pay you back. But gold? Gold just exists. Nobody can print more gold like they can print more money. No company can go bankrupt and make your gold worthless. It's a real, physical thing that holds value on its own. In 2026, with everything feeling uncertain, inflation worries, political stress, global tensions, having something that doesn't depend on anyone else's promises feels pretty good. Okay, so here's what my 10% actually looks like in practice. I split it between a few things. Some of it is in a gold ETF, basically a fund that tracks the price of gold without me having to store actual gold bars in my closet. Some are in mining company stocks, because these companies tend to do well when gold prices rise. And yes, I have a tiny bit in physical silver coins, because it makes me feel like a pirate. And also, silver is useful in electronics and solar panels. But here's the key. That 10% is not where I'm trying to build wealth. That's what my stocks and index funds are for. The gold portion? That's my sleep better at night money. Let me give you a real example. Back when inflation was spiking a couple years ago and everyone was panicking about the economy, my gold holdings went up while other parts of my portfolio were struggling. Did I sell the gold and celebrate? Nope, because that's not the point. The point is that my overall portfolio stayed more stable. I didn't panic. I didn't make emotional decisions. I kept building wealth because one part of my strategy was doing its job while the other parts recovered. That 10% bought me peace of mind. And peace of mind is what keeps you in the game long enough to actually build wealth. Look, I'm not saying you need exactly 10% in gold. Maybe 5% makes sense for you. Maybe 15%. It depends on your age, your goals, how well you sleep at night when the market drops. But the principle stays the same. A small portion in gold isn't about getting rich. It's about staying steady while you do the actual work of building wealth everywhere else. Before we wrap up, let me tell you the 3 biggest mistakes I see people make with gold, so you can avoid them. Mistake number 1, putting too much in gold. I've met people who have 40%, even 50% of their money in gold because they're convinced the economy is about to collapse. Here's the problem. Gold doesn't grow like stocks do over time. If you have half your money in something that just sits there, you're missing out on real wealth building. Remember, gold is the seatbelt, not the engine. Mistake number 2, timing the market with gold. Some people try to buy gold when it's low and sell when it's high, treating it like a stock they're trading. But gold is way harder to predict than that. You'll drive yourself crazy and probably lose money on fees. I buy a little bit regularly, just like I do with my index funds, and I leave it alone. Boring? Yes. Effective? Also yes. Mistake number 3, forgetting about gold completely. On the flip side, some people think gold is old-fashioned and skip it entirely. Then, when the market crashes or inflation spikes, they're 100% exposed with no cushion. You don't need a lot, but having none means you're putting all your trust in paper assets. That's riskier than most people realize. So here's where we are as we head into 2026. The economy is always going to have ups and downs. Inflation, recessions, bear markets, these things are part of the cycle. What separates people who build lasting wealth from people who panic and lose money is having a plan that can handle the bumps. For me, that plan includes 10% in gold and precious metals. Not because I think gold is magic, but because it plays a specific role, keeping me steady when everything else gets shaky. Now here's my challenge for you, Compendium Circle. Take 10 minutes this week, just 10 minutes, and look at your own portfolio. Ask yourself, if the stock market dropped 30% tomorrow, what would keep me from panicking and selling everything? Maybe it's gold. Maybe it's bonds. Maybe it's having a strong emergency fund. Whatever it is, make sure you have something that helps you stay calm and stay in the game. Because wealth isn't built by people who chase every hot trend or panic at every downturn. It's built by people who have a solid strategy and stick to it through the noise. That's what this community is all about. No hype, no fear, just real financial literacy that helps you build the life you actually want. If this video helped you think differently about gold, hit that like button and subscribe if you haven't already. Drop a comment and tell me, do you hold any gold in your portfolio? Or are you thinking about adding some in 2026? And if you want to dive deeper into the other recession-proof assets I mentioned, bonds, real estate, all of it, check out the full video linked in the description. Thanks for being part of the Compendium Circle. I'll see you in the next one.